His name was Georgios Andreou. He ran a tile and ceramics import business from a rented warehouse in the port district of Limassol, Cyprus. He was 53 years old. He had a wife named Elena, a daughter studying architecture in Athens, and a bank account at the Bank of Cyprus that held 480,000 euros. The accumulated proceeds of 22 years of working the trade routes between Cyprus and it. The money sat in a savings account. It earned modest interest. Georgios had considered moving some of it into property, but the Greek debt crisis had made him cautious. Property values across the island were sliding. Keeping it liquid in the bank in euros, that felt, in the spring of 2013, like the responsible choice. He kept his passbook in the top drawer of his desk, next to a photograph of his daughter's university graduation. He looked at the balance sometimes, not out of greed, out of reassurance. 480,000 euros. The number represented the arc of his adult life. 2 decades of early mornings, of containers cleared at the port, of invoices paid on time and clients managed carefully. He had not taken extravagant holidays. He had not bought a yacht. He had put the money in a regulated insured account in a Eurozone bank in a European Union member state, and believed, as any reasonable person would, that this was the most conservative financial decision available to him. He is wrong. You are standing in Limassol on the morning of Saturday, March 16, 2013. The banks have been closed since Friday afternoon. The news, arriving in pieces through text messages and a state television broadcast that interrupted regular programming at 2 a.m., is difficult to understand at first. The Eurogroup, the finance ministers of the 17 Eurozone nations, has reached an agreement with the government of Cyprus. In exchange for a €10 billion rescue loan, Cyprus has agreed to something that has never been done before in the history of the European Union. Depositors in Cypriot banks will pay for the rescue of those banks. Not shareholders, not bondholders. Depositors, the people who put their savings in. A 6.5% levy on accounts below 100,000 euros, and a 9% levy on accounts above it. Your 480,000 euro account is above it. What this channel does is not tell you how to react. It shows you how the system was designed, and who already knew what you didn't when you needed to know it most. Before we get to what Georgios discovered that Monday morning when the ATMs ran dry across Limassol, before we get to the parliamentary vote that rejected the original plan and the second deal that was worse, there is a prior question that the official account of the Cyprus bail-in has never fully answered, and the answer to that question is where the real history lives. Who knew first? Here is what the public record shows. On March 15, 2013, one day before the announcement, the president of Cyprus, Nikos Anastasiades, was in Brussels at the Eurogroup summit. The terms of the deal were being finalized in a room he was sitting in. The plan to impose losses on depositors had been under active negotiation for days. The Cypriot finance minister had been in Brussels since March 14. The Central Bank of Cyprus was aware that a deposit levy was among the options being considered, and on the morning of March 16, before the announcement was broadcast, Cypriot banking officials moved quickly to close the payment system, precisely because they knew what was about to be said and needed to prevent capital from leaving before the gate could be locked. The gate closed at approximately 5 a.m. on March 16. Italian media would later report that an estimated €4-5 billion had left Cyprus in the week before the announcement. The Cypriot far-left newspaper Harabji reported that companies belonging to the family of President Anastasiades transferred more than €21 million out of Cyprus in the days immediately preceding the deposit freeze. Anastasiades denied the allegations. An opposition party, AKEL, charged that an in-law of the president had moved €21 million to London. A minister was separately reported to have transferred €300,000 just before the initial announcement. These allegations produced demands for investigation. The investigation went nowhere. Here is what blows people's minds. Not because any of this is illegal in the narrow technical sense, but because of what it reveals about how information flows inside a system at the moment the system decides to take from you. The government knew. The banks knew. The Eurogroup knew. The ECB knew. The IMF knew. The meeting that produced the decision had been scheduled and prepared, and none of that information reached Georgios Andreou, who was sleeping with 480,000 euros in a passbook in his desk drawer, trusting that his money was safe in a Eurozone bank. The mechanism is not complicated. When a sovereign financial crisis reaches its terminal negotiation stage, information moves through institutional networks first. Governments tell their allies, banks tell their largest clients, legal firms with connections to political offices receive signals. The signal is not always explicit. Sometimes it is a phone call that says nothing direct but carries meaning. Sometimes it is a pattern in the data, a connected observer watching which accounts are moving and drawing the correct conclusion. The people who received the signal in Cyprus in the first 2 weeks of March 2013 moved money. The people who didn't receive it couldn't. Not theory, not speculation, historical fact. And Cyprus was not the first time this happened. It was the fourth documented case in the modern era in which the information about a coming confiscation reached the connected before the gate closed. And it follows a pattern so consistent across different countries and different political systems that the mechanism cannot be coincidental. It is structural. It is how power operates when systems fail. Go back to Argentina, December 2001. The Argentine banking system has been deteriorating for months. Capital has been leaving the country steadily, roughly $15 billion in the 12 months leading to the freeze. On December 1, 2001, Economy Minister Domingo Cavallo activates the Corralito, total freeze on bank accounts, weekly withdrawal limits of 250 pesos per depositor, all dollar accounts frozen. The middle class is trapped. But the Wikipedia entry on the Corralito contains a sentence that the official economic histories tend to gloss over. In mid-2001, bank owners and high-ranking officials likely knew the system was going to crash, and some, the records suggest, may have informed their highest-value depositors. These large depositors, mostly corporations, moved their funds abroad, while the banks were still publicly reassuring their middle-class customers that the system was sound and recommending that ordinary depositors increase their positions. The Corralito froze roughly $65 billion in deposits. Dollar accounts were later forcibly converted to Argentine pesos at a government-mandated rate of 4 pesos per dollar, which represented an immediate loss of approximately 40% in purchasing power as the peso subsequently collapsed toward 3.5 per dollar. If you were a corporate treasury that moved $10 million abroad in June 2001, you lost nothing. If you were a middle-class Argentine family with $50,000 in a Buenos Aires bank account, you lost $20,000 in a single government decree. Same currency, same country, same crisis, different outcomes, determined entirely by whether you had access to the information before the window closed. Same pattern, same stages, same outcome. Fast forward to Lebanon, October 2019. The Lebanese pound has been pegged to the dollar at 1,057 for 22 years. The banking system has been paying interest rates of 9 to 12% on dollar deposits. Rates that are only possible if the bank is lending those dollars to the Lebanese government at similar rates, which it has been. The government is borrowing to pay the interest it owes on its previous borrowing. The arithmetic has been visible to anyone running the numbers since at least 2016. In August 2019, the black market exchange rate for the dollar begins diverging from the official peg, a signal, if you know how to read it, that the system is cracking. The protests begin October 17, 2019. The banks close. They reopen 2 weeks later with what are described as informal capital controls. No official government order, just banks unilaterally deciding that you cannot have your dollars. Subsequent investigation would reveal that in the months before October 2019, an estimated $10 billion had been transferred abroad by bank executives, political figures, and connected depositors. After the controls snapped shut, ordinary Lebanese depositors discovered that they could withdraw $400 per month. $400 per month from accounts that sometimes held hundreds of thousands of dollars. Lebanese pound would fall from 1,507 per dollar to 89,000 per dollar by 2025, an 80% nominal devaluation. If you held a $200,000 account in a Lebanese bank in October 2019, the purchasing power of that account, measured in what you could buy with it at today's exchange rates, is now approximately $3,400. That a $196,600 difference did not disappear. It transferred to the system that managed the collapse and to the creditors and connected parties who received it. Same pattern, same stages, same outcome. Quick pause. If you are beginning to see the mechanism, not the event, the mechanism, hit subscribe. This is the Money Architect. I do not tell you what to buy. I show you how the system was built, who designed the trap, and who walked away when it closed. It is free, unlike the lesson Georgios Andreou paid in 2013. Back to Cyprus. You need to understand the architecture of why the bail-in was designed the way it was, because the design was not accidental. Cyprus had a banking sector in 2012 that was 675% of its GDP, the most oversized banking sector relative to economic output in the European Union. The two largest banks, the Bank of Cyprus and Laiki Bank, had combined exposure to Greek debt that made them, in effect, participants in a parallel Greek crisis. When the Greek government restructured its bonds in the spring of 2012, forcing a 50% haircut on private creditors, the Cypriot banks absorbed losses of approximately €5 billion. A number that the Association of Cyprus Banks would later describe in its own annual report as having wiped out the capital of the three largest domestic institutions. By 2013, Laiki Bank was functionally insolvent. The Central Bank of Cyprus had been quietly extending emergency liquidity assistance, emergency central bank loans, to keep it operational. The situation required €5 in additional recapitalization. Cyprus's GDP was €18 billion. The Troika, the European Commission, the ECB and the IMF, was offering €10 billion in rescue funds. The gap had to come from somewhere. There were, in theory, three places: shareholders, bondholders, or depositors. The shareholders of the Cypriot banks were already largely wiped out. The bondholders were a thin layer. The only deep pool of liquid assets inside the banks was deposits, specifically the €70 billion in deposits on the island, of which an estimated €30 to €31 billion belonged to Russian corporations and individuals who had used Cyprus for decades as an offshore financial gateway into Europe. The plan announced on March 16 was designed to reach all of it. The 6.75% levy on insured deposits below €100,000 was the detail that produced the parliamentary revolt. The Cypriot parliament voted 36-0 to reject it on March 19. The idea of taking money from guaranteed insured accounts crossed a line that even the most crisis-weary European government could not publicly defend. But the revised plan that replaced it was, for large depositors, substantially worse. Laiki Bank was shuttered entirely. Its uninsured depositors, those above €100,000, were left in a resolution vehicle that ultimately returned approximately 6 cents on the euro. The Bank of Cyprus's uninsured deposits above €100,000 were converted into equity at a rate that imposed a 47.5% haircut. Not a tax, a conversion. Your €480,000 became €254,400 in bank equity on the day the bank was trading at distressed valuations. Georgios Andreou did not receive a phone call. He did not have a connected law firm. He was not a corporate treasury. He was a tile importer who trusted the system that European regulators had told him was safe. He went to the bank when it reopened on March 28. He waited in a queue that stretched around the block. The ATM withdrawal limit was €300 per day. He received €300. The rest of his account, what remained after the 47.5% confiscation, was frozen behind capital controls that would remain in place in various forms for the next 3 years. Here is what the official narrative consistently omits. The 10 largest new shareholders that emerged from the Bank of Cyprus bail-in, the depositors whose accounts were large enough that the confiscated portion became equity, turned out to be predominantly Russian and Ukrainian oligarchs. The bail-in, designed in part to clean Russian money out of the Cypriot banking system, had inadvertently transferred control of the restructured bank to its largest remaining depositors, who were the very individuals the Troika had been most concerned about. Panikos Demetriades, who was the governor of the Central Bank of Cyprus at the time, would later describe this outcome with a dry precision. The effort was supposed to get the Russians out of the bank. In the end, they gave them the bank. The mechanism behind this outcome is not difficult to understand once you recognize the structure. The depositors who suffered the full 47.5% haircut were the ones who could not move their money in the window between when the decision was made and when the banks closed. The depositors who moved money before March 16, whether because they had intelligence, connections, or simply saw the patterns that the central bank and the Eurogroup saw months earlier, preserved their capital. The Rossiya Bank, a Russian bank with close ties to the Kremlin, reportedly had approximately $1 billion frozen in Cypriot accounts during the crisis, meaning they did not move all of it. But the broader pattern in the data shows a €4.5 billion decline in large deposits in the week before the announcement. The bank records did not reveal who moved that money. They do not have to. The number tells the story. He is wrong about who the system was designed to protect. The Troika told Georgios Andreou, through the official communications of the European Commission and the ECB and the government of Cyprus, that the system was designed to protect insured depositors, to protect ordinary savers, to stabilize the island's economy. These statements were made in public. They were repeated by finance ministers and central bank officials and by the Cypriot president himself. They were not accurate descriptions of what the system actually did. What the system actually did was transfer wealth from depositors who could not move their money to the institutions that manage the restructuring. The Troika received full repayment. Cyprus exited its bailout program in 2016. The bondholders of the banks were wiped out in nominal terms, but the European banking system as a whole was protected from contagion that would have been far more expensive. The Russian oligarchs who moved their money before March 16 kept it. The ones whose money was large enough to survive the haircut and receive equity became shareholders in a restructured bank. Georgios Andreou received 6 cents on the euro from Laiki Bank's resolution if he was a Laiki depositor, or €254,400 in illiquid bank equity from the Bank of Cyprus if he wasn't. The window between when the system decided to take his money and when it told him it was going to take his money was approximately 8 days, March 8 to March 16. In those 8 days, the connected moved, the rest waited. This isn't unique. The pattern of advanced capital flight before a confiscatory government action appears in at least 4 major modern financial crises with documented evidence. Argentina 2001, corporate deposits moved offshore in mid-2001, while banks recommended ordinary depositors increase their positions. Cyprus 2013, approximately €4.5 billion in large deposit withdrawals in the week before the announcement, with documented transfers by individuals connected to the president's office. Lebanon 2019, an estimated $10 billion transferred abroad by banking executives and connected depositors in the months before informal capital controls were imposed. Greece 2015, in the 6 months before the July capital controls. More than €40 billion left Greek banks, deposits falling from €163 billion in November 2014 to €121 billion in June 2015, as politically and financially connected Greeks moved money to accounts in Germany, Switzerland. and the UK before the 60 per day ATM limit was imposed on ordinary Greek citizens. Same pattern, same stages, same outcome. The modern parallel is not hypothetical, it is structural and ongoing. The Bank Recovery and Resolution Directive, the BRRT, was the European Union's direct institutional response to Cyprus. Introduced in 2014, effective across the EU in 2016, it codified the bail-in mechanism as the standard framework for resolving failing banks across the Eurozone. Under the BRRT, uninsured deposits, accounts above €100,000, are explicitly available as a bail-in instrument after shareholders and bondholders are exhausted. The United Kingdom incorporated similar provisions in its Banking Act of 2009. Canada built comparable language into its Economic Action Plan of 2013. The United States modified its resolution framework through the Dodd-Frank Act of 2010, moving away from taxpayer-funded bailouts and toward creditor contribution, which includes depositors in certain resolution scenarios. This is not speculation. This is current law in every major developed economy. What changed after Cyprus is not that the mechanism became less available to governments. What changed is that the mechanism became official. It was codified, named, published in regulatory documents that you can read. The EU's resolution framework states clearly that deposits above €100,000 are at risk in a bank resolution. The question the framework does not answer, the question it is structurally incapable of answering, is who will know before the announcement and who will know after. Here is what history shows. In every documented case of deposit confiscation or capital control imposition in the modern era, the information moved through institutional networks before it reached the public. The timeline between institutional knowledge and public announcement was measured in days, in Argentina, in Cyprus, in Lebanon, in Greece. The people who had access to those networks moved. The people who didn't, couldn't. This is not a function of corruption alone, though corruption was present in some cases. It is a function of how financial systems communicate under stress. The central bank knows before the government announces. The Troika knows before the central bank speaks publicly. The large institutional depositors know before the small retail depositors. The information hierarchy is the confiscation mechanism. The announcement is not when the decision happens. It is when the decision is disclosed to those who couldn't be told first. The passbook in Georgios Andreou's desk drawer represented something real and documented about how a system can present itself as stable, while the people responsible for its stability have already concluded that it isn't. He did not gamble. He did not speculate. He made the most conservative financial decision available to him inside a regulated system that had promised him insurance and protection. The insurance covered deposits up to €100,000. His account held €480,000. The €380,000 above the insurance threshold was never, in any legal sense, his. It was an unsecured loan to a bank. The bank gave that loan to the Cypriot government. The government could not repay. The Troika required the loan to be restructured. The restructuring took 47.5 cents of every euro above €100,000 and gave him bank equity instead. The equity was worth at the moment of conversion significantly less than the deposit it replaced. He received no call, no signal, no 8-day window. He received a statement on March 28, 2013, showing a balance that was not the balance he had deposited. The people who walked away whole from Cyprus in March 2013 were not luckier than Georgios Andreou. They were not smarter. They were better connected to the information networks that operate inside financial systems during systemic stress. The question that the Cyprus bail-in poses, and that every crisis since has reinforced, is not whether governments will confiscate from depositors again. The BRRT answers that question. They will. The mechanism is legal, codified, and established precedent. The question is, by the time the announcement is made, will you have had 8 days' notice, or will you be reading a bank statement you don't recognize? The pattern is mathematical. The outcome is structural. The information asymmetry is not a bug in the system. It is the system. Now go read the fine print on your bank's resolution status before someone else reads it first.